You probably have stocks and bonds in your portfolio, but have you considered farmland? I'm Jack Otter, editor of Barron's.com. I'm here with John Taylor from U.S. Trust. You are the leader of the farmland business at U.S. Trust, a business that most people probably don't even know U.S. Trust is in. But before we talk about that, let's just talk about the investment case for farmland. Why would someone want that as part of their portfolio?
You know, Jack, that's a great question. I think the main thing is it's got a very low correlation with the market. Okay, and you know, over the last few years, I think that's one of the lessons we've all learned is if you can get something that's not correlated with the market and really will diversify your portfolio, that's a great thing. The other thing is, you know, if I kind of talk in the portfolio speak, it's got an asymmetric risk curve on the downside, right? So what do we mean by that? Well, a stock can go to zero at some point in time, and you know, a bond can go to zero. Land can't. Okay, so can land go down? Absolutely.
We've seen that recently.
We have, but can land, you've never seen a sign that says, you know, we no longer want the land, come by my kitchen table, my wife and I'll sign you the deed, you know, because it goes to zero. Doesn't happen. So asymmetric risk curve on the downside. The other interesting thing on farmland is there's no vacancy factor, and I know in New York that probably catches some people, you know, a little bit by surprise because you think about high-rise buildings or you think about retail or you think about malls, and all of them tend to have some type of vacancy factor. Good farmland doesn't. Good farmland is farmed every single year in the U.S. So you've got a very stable income stream. Can that income stream vary? Certainly, as prices go up of commodities, you know, those rent payments can go up. As prices go down, they can go down a little bit. But again, they don't go away. They don't go to zero because farmland is leased every single year. So I think it's a stability of a current yield. And unlike a bond, a yield that can rise over time as commodity prices rise, so it's got a little bit of an inflation hedge. And then similarly, the land value has some of an inflation hedge.
Well, certainly you have a lot of good people advocating farmland. Jeremy Grantham, for one. Also, Warren Buffett recently had an article in Fortune. Now, he was really making an analogy to how to be a stock investor, but he owns farmland and likes that investment. How did U.S. Trust get in the business?
Yeah, it's a great question because I think a lot of people are surprised when they find out that, you know, that we're in farmland and that we manage it. Oddly enough, we're probably one of the largest fiduciary managers, if not the largest fiduciary manager of farms and ranches today. So if you look at U.S. Trust today and all the predecessor trust departments that are today a part of the U.S. Trust franchise within Bank of America, we find that we've managed farms and ranches for over 60 years, or right around 60 years. I've got 16 full-time farm and ranch managers today. We manage 950 properties, give or take. It's probably, you know, over 1.2 million surface acres and over $1 billion in market value. So that's the kind of the aha moment. So we didn't just get into this to say, you know, farmland's an interesting space. We've been managing farms and ranches for our clients for a number of years, and I think as farmland became more and more you know, on the radar as an investable asset class, it was very easy for us, having managed this, to take that next step.
Now, obviously, we're talking about wealthy investors here.
Correct.
This is not an easy thing to get into, and you don't buy shares like you're buying shares of Apple or IBM.
That's true. You know, we've got a lot of the farmland guys that work for me, and we'd all love to invest in farmland, but we're just not quite at that stage yet because it is a direct investment. So it is for our very high net worth clients because it's not a pool fund, it's a direct investment in farmland.
And then, so what's the entry level here, more or less?
Typically what we look for is a $5 million minimum. That usually lets us get them a couple of good farms. Typically today, if you're looking at it, you know, you're probably going to want to buy a farm in the $2 to $2.5 million range. You can certainly buy them for more than that, but we at least want to get a couple of good farms, you know, so that kind of it starts at the $5 million level.
Now, there has been some talk, we're not the first people to talk about this investment. There's been talk that maybe there's a bubble going on here. I was reassured recently when I saw Harry Dent saying it's overpriced. If he's saying that, it's probably very safe. But still, address that issue. You know, prices have gone up nicely. Have they gone up too far, too fast?
They have. You know, I got asked that question. We were at a DTN Ag conference in December of last year, and it was more of just the producers and a lot of the farmers and folks that were there, and was speaking to some of those guys in one of the discussions, and really what we see is I think you've got a bifurcated market. and you probably have for the last 2 to 3 years in farmland. 70% of the farmland last year, roughly, was bought by farmers, not by investors. And so when you look at what we're paying for farmland versus what some of those the farmers are paying, there's probably a 25% differential in a lot of cases, what we would say is a premium. The way we buy farmland is I look at
the farmers say ripping off a city guy.
No, I mean they look at it and I understand. I mean they go, well, I've got 1,500 acres, this 80-acre tract right by my fence line, or within a quarter of a mile from me is coming for sale. They will pay a premium for that because it comes for sale maybe once in their lifetime, and it's a chance to add to their acreage. They kind of look at it, well, I know I've paid a premium, but if I average it in with all the rest of my land, it doesn't matter. I have to be much more disciplined. I have to look at what I can pay dollars per acre for that acre of ground and what I can lease it at, because I want to drive a cash return. Our view is that we should be able to drive at least a 4% net cash return, net of our fees, property taxes, and insurance, back to our client's account. So we have to be very disciplined about what we will pay, not emotional on looking at the dirt. The neighboring farmer does. And then if you go back 2 or 3, 4 years, we've had some historically good years in the farming community, so the farm income has been up, and they've deployed a lot of that cash. Now that commodity prices have moved back down a bit, I don't think you're going to see as much cash chasing those premium prices. So hopefully that kind of bifurcated farm market tends to close and comes back more to the way we've been paying for farmland versus the premiums, which we could just never justify.
Gotcha. And finally, we will point out that this is an investment that not only has some capital appreciation, but nice income, and that's one of the reasons it's attractive.
And the interesting thing, we have tended to focus on a cash lease. You can do a crop share lease, which was historically the norm. Now cash leases are probably more the norm. And a cash lease, by that I mean literally I'm renting the dirt, okay? But on a cash lease, I've moved the weather exposure and I've moved the commodity price risk to that tenant. So I've taken 2 big pieces of risk out of the equation. And on that cash lease, you get the same rent. Typically we'll do a 3-year lease, so each of those 3 years you're going to get a fixed rent. Then you renegotiate that lease 3 years down the road. So if prices have moved up, that rent can move up. So that's the other part. You can, over time, if you look at the long-term trend of commodities, which have tended to move up, those cash lease prices will move up. So that yield will keep pace with inflation and keep the same kind of ratio that it should have with the underlying value of the dirt.
John Taylor, thanks very much.
Thank you very much.